Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. I hope you've been enjoying the last few days, and it's a busy trading week ahead. I say busy because, of course, a lot of organizations are going to be sort of starting to calm things down as we go into the holiday season around the world. And the problem with that is people just got excited about the upside in the US stock market and the Australian stock market too, and other Western markets around the world. Got a little bit excited last week, the week before, and it came at the end of a very strong rally period for US stocks, and then that burst higher that we cautioned on the day would probably be unwound, and it has been. US stocks have steadily fallen back in on themselves and are now risking sort of a very accelerated move to the downside. Now, I don't say that lightly, but I do want to emphasize that there is a real risk period here for the US stock market. Now, it would be nice to think that the market can hold near current support levels and begin to strengthen. Certainly, if we see the market back above the high of the last 3 trading days, I would be neutral to even a little bit bullish. But while we're in this immediate consolidation range of the last 2 days, and as I speak, we're really testing the bottom of that range to the downside, I think it is possible that that big burst to the upside we saw was the last gasp of the bulls, if you like. In other words, that last gasp of, well, bad data equals the Fed slowing, that's great for stocks, which is a completely illogical argument, and I could spend some time explaining that to you, but often equity markets and the interest rate market and the Federal Reserve's rate settings respond to the same stimuli, the economy. That's why sometimes you can have rates going up as the stock market goes up. You can have rates going down as the stock market is going down because they're being driven by the same stimuli, Main Street USA, the real economy in the USA. So this time around, though, everything is very different and people are not paying enough attention, and that's why there is a market opportunity. What is different is that the US economy is going down and interest rates are going up. That is the difference. Now, you can debate inflation and whether it's demand or supply disruption driven, but certainly it is not as responsive to interest rate hikes as has historically been the case, which is why Federal Chair Powell has already warned that interest rates could stay high for longer than the market thinks for a considerable amount of time. Now, that will only force the US economy to continue to self-implode. As I said, think about this. It's not rocket science. The economy is going south. Interest rates are going up. What's the outcome? An even lower economic growth period for a considerable, in fact, way beyond the considerable of interest rate hikes. So we're looking at a 1 to 3, perhaps 5-year economic slowdown in the USA. Are stock markets accurately reflecting that at the moment? No, they're not. What they're reflecting is a temporary soft landing to the US economy. They are not pricing in a much deeper, sustained recessionary period, which we have been warning of. We forecast accurately and correctly December last year, we forecast the US would have a recession in 22. We forecast that US stocks would fall 20% in 22. And they did. The US had a technical recession in the first 9 months of the year. It's only grown 0.4%, and the stock market fell 20%. We were the only ones saying that in December 21. The rest of the market was bullish. I then wrote in the first week of January that those new historic highs we were seeing, all-time historic highs in the US 500, the US stock market in general, I wrote a piece that week. I said, these could well be the highs for the year. It has happened before. And that is exactly what we saw. We said all those things when no one else was saying it. The Macquaries, the BlackRocks, the Goldman Sachs of the world. all of them, JP Morgan, whoever you want to name, were all incredibly bullish, expecting an economic acceleration and a major bull market for the stock market. We were the only ones who said anything different. Now, December 2022, I'm again saying the US can have a recession in 2023. Again, I think, technical, not only technical, but very real recession. And I'm even more confident of that forecast than I was of last year's technical recession forecast. And I again think we can fall 20% in stock valuations from here, maybe even 30% this year, given that the economic crunch is going to be severe. US consumer sentiment data out on Friday confirmed that, yes, I mean, everyone, all the people who want to get you excited and trading a lot said, oh, sentiment data is up. That's great. Sentiment data bounced at all-time historic lows. It's terrible. US consumer sentiment is depressed, majorly depressed. And US consumer sentiment index, which I've used all through the last year and a half to forecast that the US economy was slowing, because I know for a fact from several decades in this business that the US consumer is a lot smarter than the Wall Street economist who said everything's going to be wonderful. No, the US consumer could see it coming, but the Wall Street economist couldn't. And that's our tremendous market opportunity. We love when the big guys have no idea. And they haven't had any idea. Now, in December 2022, we're seeing the CEO of Goldman Sachs saying, oh, the US is headed for depression, for a severe recession. And other people are saying it too. Bank of America came out with similar forecasts in the last week. Okay, they're saying what we've been saying for a very long time. They're catching up. They haven't read it well. They've got carried away with their own Wall Street subculture instead of looking out the window of what's going on in the world and realizing that out there in Main Street, USA, things were not well at all. And that's before inflation came along. That's before a war happened. I forecast this before there was a war. And the war has, in Ukraine, tragedy that it is, has meant even more severe price dislocation and inflation. Now, that inflation may have peaked, but that's not what matters. What matters is the US economy is going south regardless of what the inflation number is doing, and as consumers retrench, and the Fed is continuing to hike interest rates regardless of whether inflation has peaked or not, because they need to see it so much lower than it is now, even if it has peaked. And slowing to 50-point rate hike increments is not something to celebrate. That is aggressive interest rate hiking. It may not be as aggressive as 75 points, but it is still aggressive interest rate hiking that is going to continue to hammer the US economy to the downside. It is not a happy outlook for the USA as we approach 2023. Watch for it's interesting, it's called 2023, because I would suggest you watch for a 20%, 30% depreciation in stock values through the coming year. Thanks very much. I hope you have a great and exciting week ahead. Clifford Bennett, Chief Economist, ACY Securities.